Hey guys, welcome back to another episode of hearing me bump my gums. Anyway, what I want to talk about today is the SPX and the NDX. Okay, what I have learned over the years is that it's easier for us to have our wins in our zero DTE when the volatility is higher, or at least it's easier. That's the real word I'm saying. It's easier when the volatility is higher versus when the volatility is low. So I've been looking around to see if I could find something that had a higher volatility than the SPX. Well, there is something that has a volatility in the SPX. It's the NDX, which is uh, the Nasdaq 100. Okay, and we know it moves, so it had to have a higher volatility. And of course it did. And I liked it, okay? Even though the volatility is low on it as well compared to itself, it's still at like 15, 16, 17 versus the volatility on the XPX is like high 11, 12, 13s, okay? And it's hanging around in the low 12s, maybe 13. So uh, it's not that we can't win, and it's not that we can't win consistently. It's just that it's harder to win. Okay. And hey, if you had a choice between harder and easier, which one would you choose? I would choose easier. Okay. So I started looking around, seeing what I could find. And I even practiced trading it for a little while. I traded the NDX, and I was trading both of them just to see how it worked. I did this for about 2 weeks, and I was liking the NDX because for some reason they don't charge as much. The commissions are the same, but the fees are cheaper. For instance, on the SPX, they charge you on any stock. They charge you a fee plus the commission. Okay. Well, on options, the fee on the SPX may be, for at least for me, it's like I don't know, 40 cents. Where the fee on the NDX is like 2 cents, okay, per contract. So that's a major difference, okay? Major difference. So, which will make your profits higher, okay? So I was looking around. So if I can have my profits higher and it makes it a little bit easier for me to win, it was worth investigating. So I had to investigate it and trade it. And I had some wins on it, okay? But this is what I discovered on them. Okay, let me point this out to you. Okay, I hope you can see this. This is the SPY for today, expiration, okay? And the SPY closed at 47.09. I want you to look at the open interest. The open interest on those two strike prices, which are the 47.05s and the 47.15s, and these are calls. The open interest is 4,651 on one, 1,166 on the other one, okay? And look at the deltas. Is that a 5 and a 4? Okay, now, this is the NDX. As you can see, the NDX closed at 16,562. So the at the money would be the 15,560s on the call side, okay? Now let's look at the open interest. The open interest is 2, and the open interest on the other one is 1. And as you can see, the deltas are about the same. So I'm at the money. It's a 0.51 and a 0.48, okay? But now it's not going to show the volume because the market hasn't opened yet. I wish it would, because the volume is just as vastly different as the open interest. What volume is how many shares or how many options were traded that day. What the OI is, it stands for open interest. That's how many contracts or how many positions are already opened or in that particular strike price. Basically, how many people own that strike price already, or how many contracts are owned by someone in that strike price, okay? There's a major difference. Well, you say, well, Robert, why does that make a difference? Let me tell you why that make a difference. It messes up the bid and the ask. And we don't pay the bid or the ask. What we try to do is get somewhere in the middle, right? So I'm going to show you the difference between the bid and the ask on the SPX and the NDX. And then I'm going to tell you why that makes such a big difference. Okay, here we go. This is the same NDX. As you see, the open interest is low. They're still. Now let's look at the bid and ask. And we're only going to look at the net down there. We're not even going to look at, well, we'll look at all three of them. Okay, the 16,560s, you got a bid of $60.30 and an ask of $63. That's $2.70 difference, okay? $2.70 difference. And then the mid price is $61.65. Guys, when you're only trying to make 50 cents or 30 cents, that's a wide spread, okay? Then look at the other one, 65.40 to 68.20. That's $2.80. And the difference between that is a lot. Okay, now let's look at the spread, which is actually what we'll be trading, the spread price, which is the net credit, okay? The net credit on the bid is $2.40, and the ask is $7.90. Guys, that's $5. And the mid price is $5.15. So if you got in at $5.15 and you're trying to get out, that's a $5 and what is that? That's a $5.50 difference in price. That's a lot, guys. To get in and get out is going to be hard because you don't have enough people trading. As you can see, the volume is really low and the spread is too wide. And not having enough volume or people in the trade is what makes the spread so wide. The liquidity of that, liquidity means it's a lot of movement in it, okay? A lot of people in it. It's traded a lot. It's just not enough liquidity in that. It's just not enough, okay? Now I'm gonna show you what the SPX is, where it is, and why we have to just stick with the SPX. Okay, this is the SPX, and as you can see, it's the same one, okay? Same deltas, same strike price. Okay, now, the 4705 is going from 14.20 to 15. That's 80 cents difference, okay? And the mid price is in the middle of that, which is 14.60. That's major. And then over here, on the other one is 9.70 to 10.60. That's 90 cents different. And the mid price is 10.15. Well, when we look at the spread, it's going from 3.60 to 5.30. That's what is that? 5.30, $2. It's $1.70 difference. Guys, that's a major difference than a $5 difference, okay? And that's on one that's expensive. We're not even trading the ones that are this high. And then once the market opens up and the volume picks up, you're gonna see that spread will probably get smaller. So as much as I like the volatility being higher on the NDX than the SPX, which is the S&P 500, the NASDAQ 100 versus the S&P 500, I just couldn't do it. I've done it for a couple of times and I like the low commissions and all of that, but that being able to get in and out of a trade is more important than having a high volatility, okay? So we got to go with the liquidity. And I want to show you one more thing. What I'm going to show you now is the VIX on both of them, or the volatility on both of them, the fear index, okay? Hang on a minute. Okay, the only way that I could get it was on a chart, okay? This is the VXN, which is the NASDAQ volatility index. Okay, now, these lines are in, what are they? They're in 20 cents increment, that's not true. They're in 10 cents increments. Okay, let me increase it a little bit to, maybe I can, if I increase it, it really won't be nowhere. But anyway, gotta leave it there. I'm putting it at 0%, okay? Which is the real thing. Okay, these are in 10 cents increments, and as you can see, the volatility closed yesterday at 1535, okay? That's where it is now, 1535. It moves before the market opened. It closed looked like maybe it's 1530, so it only moved up 5 cents so far this morning. Now, let's look at that's 15. That's if the SPX was at 15, we would love it. Okay, this is the SPX, which is the VIX. That's it's at 1219. Okay, and this is in, oh my goodness, this is in 2 cents increments. Now wait a minute, 2 cents increments. Wow. And this thing right now is at 1219. Okay, so that only seemed like a couple of points, but a couple of points, whole points, is a major difference. As you can tell, if I'm telling you that I wish it could be at 15 or 14, and I would be a lot happier, and then you see this thing is in 2 cents increments, this chart here, 2 cents increments, okay? And then the other one was in 20 cents increments. But that in itself gives you an idea of how big of a thing. This thing could move up, and it still would only, the high on this chart for yesterday was at 12, maybe 1250. Okay, and then it moved down to 12, all the way down here to about 1205 at that low point right there. But it closed at about, what it closed at? Looked like about 1218. So I'm gonna tell you something. That volatility makes a big difference. So when I put all them things together, the liquidity, the volume, and then that was the bad part about the NDX, and the good part about the SPX. The volatility right now, that's the bad part about the S&P 500, and the good part about the NASDAQ 100. But when I weigh everything, I gotta go and stick with the S&P 500. Okay, it just has more liquidity, and you could trade the NDX, if you was trading one contract. But when you start trading 10, 20, 25 contracts and more, you can't take the chance. You'll be sitting at a price, and it'll just be sitting there because you'll be trying to get out at the mid price, right? And it'll just be sitting there, and it would never feel until something bad would happen. And then it may feel, you know what I mean? Or something extremely good would happen. And we don't want to do that. Now, the one thing that it might be great for is, for instance, if you putting on a trade and want to let it go all the way to expiration. But even with that, you have to be able to get out of a trade in case things go bad, because there's not 100% chance that you're going to win every time. So when I weigh all the pros and cons about the SPX and the NDX, my conclusion is I gotta stick with the SPX, which is the S&P 500. It has more volume, and you can get in and get out. That volume means safety. Volume means liquidity. That means you got some wiggle room. What good would it be if you could buy a house that's showing to be really, really high, but then when you get ready to sell it, nobody wants to buy it? In fact, that's what a lot of these, mega rich people do with their houses. They buy a house, they remodel it, renovate it, upgrade it, and take it up to an astronomical price. And the stuff that they spent money on was only stuff was good for them. It's not good for selling. Like, for instance, I don't know nothing right now, but all the custom stuff that they do, and it jacks the price value of the house way up. But when they go to sell it, the next person don't want that stuff. So the price ends up coming way down. Well, that's kind of how it would be with the NASDAQ. It's not enough people that want it. So when you're in it and trying to get out of it, it's hard to get out at a profit because there's not enough people that want to buy it at the price you're trying to sell it at. So you'd have to bring the price either way up or way down, depending if you bought to get in or sold to get in. But either way it go, it makes for a scary situation if things go bad. And you just can't do it. Anyway, guys, that's my take on the SPX versus the NDX and trying to find something with a higher volatility than the S&P 500. And again, the only reason why we were looking for that is because it's just a little bit easier to win when the volatility is higher. If you do the statistics on winning when the volatility is high versus winning when the volatility is low, it's just a little bit easier. You have to be a little bit more crafty, a little bit more careful, maybe take smaller profits and all of that when the volatility is low. So anyway, guys, that's my 2 cents. And until the next time, peace out and keep it slow.